After the carnage of Q4 2018 came the recovery, with equities enjoying one of the strongest starts of the year in decades. Just as the market rout was triggered by the US Federal Reserve's tightening, so the recovery was inspired by an about turn by the Fed, with an unexpected and sharp shift to monetary easing. January's surge, the strongest since 1987, faded, and by the end of the quarter the prevailing mood turned more cautious. Nevertheless, the return of 10% from global equities in sterling terms in Q1, led once again by the US, recovered much of the ground lost in Q4 and left Wall Street within touching distance of its all-time highs. As notable as the big move in equities, perhaps of greater import was the move in bond yields, with sharp falls particularly in longer maturities and especially during March. The yield on the 10-year UK gilt fell by nearly 30 basis points, taking it down to 2% and producing a return of over 3% for gilts over the quarter. The key drivers of markets this year have been the increasing evidence of slower global growth, most prominent in China and Europe, and to a lesser extent the US, and the response of central banks to this slowdown. Having pivoted to a more dovish, patient policy approach in December and January, the Fed delivered a surprise to the market in March when, in effect, it called a halt to its tightening cycle. This means that quantitative tightening, which has significantly reduced liquidity in the global financial markets, will be brought to an end earlier than was previously anticipated. While less important than events in the US and China, Brexit continues to dominate headlines and political discourse in the UK and Europe, and the overhang in the UK financial and financial markets is notable. The IPlus portfolios posted positive returns over the first quarter, ranging from 2.4% for IPlus 3 and 6.2% for IPlus 6, which were comfortably ahead of their short-term inflation plus prints. Returns were positive across most asset classes over the quarter, led by global property and global equity, with 12.3% and 10.3% respective returns, followed by UK equity, which returned 9.4%. All of the portfolios underperformed their relevant strategic asset allocations despite their strong returns. This is because within equities, our managers struggled to keep up with a strong market rally, but this is to be expected from our slightly conservative manager blend. Within fixed income, the underweight allocation to duration was a detractor given the significant decline in bond yields over the quarter. Additionally, gold underperformed the broad commodities index, and UK property underperformed global properties, which are used in our strategic asset allocations or our market benchmarks, for want of a better word. For the 12 months, the IPlus portfolio's performance ranged between 0.3% for IPlus 3 and 7.3% for IPlus 6 in what were difficult market conditions. Our equity allocation is broadly in line with the strategic asset allocation. Within equities, we continue to have an overweight to emerging markets. Towards the end of 2018, we were adding to equities as valuations opened up after market declines. Within fixed income, we've been selling duration, which is sensitivity to interest rates, by reducing longer-term government bonds and adding to short duration bonds. We want to reduce the sensitivity to interest rates in case rates increase over the next few months. We've also been reducing the allocation to real assets and reallocating the portfolio risk to better value developed equities. Investors are right to be worried about trade wars, Brexit, and most importantly, slowing global growth. Leading indicators continue to point to weaker growth, especially in Europe. While returns from bond markets have been good in recent months, the falls in yields point to a structural as opposed to purely cyclical concerns and mean that future returns will be lower from here. Furthermore, equities have recovered a substantial portion of the falls in the fourth quarter of 2018 and at current levels are not priced for further deceleration in growth or indeed a slide into recession. However, there is no sign of inflation on the horizon despite the length of this economic cycle, and the low levels of unemployment, especially in the US, provides considerable leeways to central banks and it eases the fear of policy errors. Interest rate rises are a distant prospect across the developed world. The big shift in monetary policy and the sharp falls in longer-term interest rates provide strong support for valuations of risk assets. The policy backdrop will remain supportive through this year, and we expect some of the major areas of uncertainty which have held back confidence and investment, notably US-China trade wars and possibly even Brexit, to begin to lift. We therefore expect further progress in markets during 2019. However, we recognise the risks of an unfavourable outcome to some of these events and the resulting extended uncertainty, as well as longer-term problem of excess debt in many countries, which contain the seeds of a more serious economic slowdown. These uncertainties are enough to keep investors nervous and to trigger bouts of volatility, especially following the sharp rise in markets this year. Some period of consolidation is therefore quite likely, but we view the medium-term outlook as broadly positive and will use periods of weakness to accumulate risk assets.